It's clear we've gone through an enormous roller coaster in monetary policy. We had this huge increase in the money supply after the pandemic hit, and then that was followed by a huge increase in inflation. Then the Fed switches into reverse, and we've had this huge contraction in the money supply, and we have coming slowdown in inflation. So money supply goes way up, inflation goes way up. Now the money supply comes down and inflation starts going way down. I think we'll have a recession because of this contraction in the money supply. So that roller coaster ride effect of the money and monetary policy is one factor. The other factor, I think people intuitively they're worried about this free spending in Washington, expansion of government deficit, huge deficits, a huge accumulation of debt. And that worries them because that they know if they're running their household or business, that's not the way it goes. You go bankrupt eventually. And basically, that's what the Congressional Budget Office has told us. They've indicated that the level of debt in the United States is not sustainable, and interest expenses, I should say, are going up faster than anything else in the budget. And now interest expenses are actually greater than defense expenditures and Medicare. And the total debt is $35 trillion. Okay, that's a big number. It's over 100% of GDP. But if you look at the unfunded liabilities, those are about 4 times higher than the stock of debt. It's about 120 trillion. Those are promises that have been made that when I say unfunded, they haven't been funded. Taxes haven't been collected to make those payments on those promises that are already in the book. So we have a huge debt and deficit problem. And I think the third thing that generally kind of bothers people is that they realize that more and more of the power to make decisions about the economy are in the hands of politicians. In short, they're in Washington, D.C., instead of being in businesses and corporations and private households. So I think in general, that's the main thing. The roller coaster in monetary policy, huge expansion and uncontrolled government spending that everybody knows can't continue. And if it can't continue, it'll stop. And people know, will you stop it by increasing taxes, direct taxes, or inflation taxes, one of the two. Obviously, if you've got money and got money in the stock market, it's doing very well. There's no question about it. However, if you look at the median wage, the real wages adjusted for inflation have gone down. That's another reason people are worried. It's a pocketbook thing. If this gets back into the monetary policy thing, if you goose the money supply, what happens? With a lag, asset prices go up in about 1 to 9 months. Well, the stock market went way up. Real estate went way up. If you own stocks and you own real estate, you made out like a bandit. But what if you didn't? Well, you didn't do very well because inflation was eating away at your wage more rapidly than your wage was going up, and you actually were getting behind the curve. So if you go down lower on the wealth specter, you find that it doesn't look so great. The middle class and lower middle class and low income levels are behind, have retreated. If you look at the billionaires, by the way, which I've done, the billionaires' share, if you look at the total wealth of billionaires relative to GDP, it's gone up. Their share has gone up. So it's just been great for billionaires. There's no question about that. I think a little bit this reading of the economy being so great, it's a little bit the tooth fairy. If you really get under the hood and you start looking at it carefully, it's been good for some, but not so good for a lot of people. And that's why a lot of people are complaining about it. You've got to go back towards less government, more free market economy, more private sector, more deregulation, and a key is stable monetary policy. Why have the rich gotten so rich in this period of Bidenomics or post-pandemic period? Because of the Fed. It's all placed on the Fed. The money supply should be growing. Hanke's golden growth rate, consistent with a 2% inflation target, it should be growing at about steady 6%. Well, at one point in 2021, and remember in February, it was growing at 17% year over year. That's a record. That's the highest it's ever been. And now it's dropped down to about 2%. So this is a roller coaster. You've got to get back to monetarism and the quantity theory of money and steady monetary growth. That is one factor. Then the next thing is more free markets. But what we've done, we've adopted industrial policy. We've adopted an approach where Washington's going to be making more decisions about how capital is allocated and how the economy runs than in the past. So that's bad. We're basically copying, I like to say, we're copying China. And we have formally, about a year and a half ago, the Commerce Department under Biden actually came out with a statement that we are adopting formally industrial policy. A lot of industrial policy, all the tariffs, protectionism, managing the economy. Well, I'd go back to the playbook that we had in the Reagan administration and just implement it. I just go back to Reaganomics. That's a little what I call bull dust. The record, you've got to look at the facts. And the facts are Reaganomics turned around stagflation. When Reagan came in 1980, we had stagflation. He turned that around. And what happened in the 1990s was largely a result of what was set up by Reaganomics in the 1980s. We had a tremendous decade. And what we had, by the way, a big peace dividend in the 1990s with the defense expenditures coming down. Now they're going up. If you want prosperity, you've got to let markets function. That's the point. Let's now talk a little bit about trade. Why did Japan have such a huge trade surplus in the past? They had it because they saved a lot more than they invested, and the U.S. saved a lot less than they invested. So we had the deficit, they had the surplus. Now it's shifted. China is the big one. They save a lot in China, and they save a lot more than they consume, and that means that they have a trade surplus. Switzerland does the same thing. They have a trade surplus because the Swiss save a lot more than they invest. And the deficit countries are just the opposite side of the coin. The most fiscally conservative president we've had since World War II is who? It's Bill Clinton. Remember, Bill Clinton in the 90s, he actually ended up with 2 years of, we were running surpluses. So those years, they were squeezing the deficit out and ending up with surpluses, and we had pretty strong growth. It turns out that the potential growth rate in the U.S. is actually sliding down a little bit because of government expansion, squeezing the private productive sector out of the economy. That's one reason it comes down. And associated with that, in a concrete way, well, there are more and more regulations. Just think of all the regulations. Think about building a house. Why are houses so expensive now? You've got 10 million regulations you've got to comply with that add tens of thousands of dollars to the price of constructing a new home. It's just due to building standards and regulations. That's just one example. But the whole idea is, do you want someone in Washington making decisions for you and the economy when those people don't pay the cost of making bad decisions? Why does the private sector work as well as it does? Because they're in a profit and loss system, and if they screw it up, they make a loss, and they might even go bankrupt if they make too many bad decisions. In the public sector, that doesn't happen. You can make one bad decision after another, and it doesn't make any difference because those bureaucrats and politicians really have no skin in the game. They're not operating in a profit loss system. I'm actually on the board of an organization called the Federal Fiscal Sustainability Foundation. And what we've been pushing on is a convention of states under Article 5, which there are enough states since 1979 to actually do this, and focus on changing the Constitution and putting in something like a Swiss debt brake where the government expenditures could not go up any faster than the economy grew. Now, that means that the size of the government relative to the total size of the economy would stay the same. The government couldn't crowd out the private sector. So that's happened in Switzerland, by the way, in 2001 when they changed their constitution. The other thing is that the budget would have to be balanced. That would solve the problem. But you have to do it with a constitution. We've tried to do this in the United States with statutory changes in the law, but those are really kind of Band-Aids that eventually tear off after a couple of years and the thing falls apart. I think it might be the biggest thing that came out of the BRICS summit. You see the BRICS, it's a good thing in the sense that diplomacy works. People are meeting, they're talking with each other. And it turns out you had what I call the big three. The three most important foreign ministers and most competent are Sergei Lavrov from Russia. He was there. And you mentioned the Minister of External Affairs from India, the Foreign Minister, Johns Hopkins, and then Wang Yi from China. So those are the only three foreign ministers in the world who I think are in the A club. And they were all at BRICS. And a concrete thing came out of it. They appear to have settled this border dispute, which is a big deal. Borders are always important. If you have a dispute about a border, you have a potential for a war. Why do you think we have a war in Ukraine? Because there was a border dispute. Why do you think the Middle Eastern thing is flaring up? You have border problems. Who's going to control Gaza? Who's going to control the West Bank? What about the border between Israel and Lebanon? Those are all border things. That's where wars flare up. And we have one that looks like it was tamped down. You had other things in the BRICS conference, I think important. One is that they're against sanctions. Well, I'm against sanctions too. It's a form of protectionism. They always backfire. They never work. They also clearly supported the IMF, supported the G20. This is unintended consequence of sanctions. If you look at the history of sanctions since World War I, they simply don't work. They're counterproductive. You put sanctions on somebody and it helps them and hurts you. You look at what's been going on, for example, Russia. We're putting all these sanctions on Russia. Russia looks like it's going to grow, according to the IMF forecast, 3.2% per year. The Eurozone is going to grow less than 1%. France, 0.7%. Germany, 0.2%. They're in a state of depression. Now, why? Because of the blowback from sanctions. They put all these sanctions on Russia, and of course that cuts off goods and services that Russia was exporting to Europe. It hurts Europe. Well, the easiest way to stop all of this is, number one, drop the sanctions. And how many Western troops are actually in Ukraine? You know, they're going on and on about the damn North Koreans. I'd like to know how many Western mercenaries or incognito NATO troops are actually in the Ukraine. We know, by the way, the firing of any of these sophisticated missiles and so forth requires NATO guidance and backup. So this is kind of a game being played. To stop the war, the easiest way to do it is stop the U.S. funding of the war and come to the peace table and cut a deal and stop killing Ukrainians. You've got the destruction of Ukraine, and the numbers vary, but it looks like around 600,000 Ukrainians have been killed. If you want peace, the best way to do it is cut the funds off. It's like anything else. If you want to stop something, cut the funds off. If you want to stop a car, cut the gasoline off. Or now that we have EVs, don't recharge the damn battery.